Something wild happens the moment you step into the world of investing. You're hit with a storm of words you've never heard before. Bulls, bears, cap, margin, volatility, liquidity, shorts, dividends, blue chips. It feels like everyone else is speaking some secret language, and beginners are expected to just figure it out. But not today. By the end of this video, every stock market term you've ever been confused by will finally make sense. And once you understand these terms, I promise that investing becomes less scary, less confusing, and a lot more exciting. Stay with me till the end, because once you learn the full vocabulary, you'll navigate the market with the confidence of someone who's been investing for years. Let's start with the word stock. A stock is simply a tiny piece of a company. When you buy one share, you own part of that business. If that business grows, your share becomes more valuable. If it struggles, your share loses value. It's that simple. Many beginners forget that stocks are actual ownership, not just colorful charts on a screen. To buy a stock, you need a broker. This could be an investing app or a traditional brokerage firm. The broker connects you to the stock exchange, which is the marketplace where buying and selling happens. You can think of it like an online store, but instead of shoes or electronics, you're buying little pieces of companies. Every company has a ticker symbol. These are short codes used to identify stocks quickly. AAPL for Apple, TSLA for Tesla, AMZN for Amazon. That's all a ticker symbol really is, a shortcut. People often misunderstand stock price. A low price doesn't mean a company is cheap, and a high price doesn't mean it's expensive. What really matters is something called market cap. Market cap means the total value of the company in the stock market. It's the stock price multiplied by the number of shares. A company with a $5 stock price can actually be worth more than a company with a $500 stock price depending on how many shares exist. This brings you to an interesting question. Do you personally prefer investing in big, stable companies or smaller ones that might grow faster but come with more risk? Drop your answer in the comments. I want to see how you think as an investor. Let's move on to bulls and bears. A bull market means prices are rising or are expected to rise. A bear market means prices are falling or are expected to fall. These terms describe the overall mood of the market. Some people love bull markets because everything feels positive. Others love bear markets because it gives them a chance to buy stocks at lower prices. Then there's volatility, which describes how much and how quickly stock prices move. High volatility means big price swings. Low volatility means steady, predictable movement. Anyone who has ever checked their portfolio and felt their heart jump probably experienced volatility firsthand. Liquidity is another important term. Liquidity means how easily a stock can be bought or sold. Highly traded, popular stocks have high liquidity. You can buy or sell instantly. But some smaller or lesser-known stocks have low liquidity, meaning it might take time for your order to go through. Speaking of orders, you'll see different kinds. A market order means you want to buy or sell right now at the best available price. A limit order lets you set the exact price you want. A stop-loss order is like a safety net. When the stock falls to a certain price, it sells automatically to limit your loss. Many beginners lose money because they don't understand these orders well. Now you do. Your portfolio is the collection of all your investments. Stocks, bonds, ETFs, real estate funds, everything you own as an investor. A good portfolio has something called diversification. This simply means you don't put all your money into one stock or even one type of stock. You spread your money around so that if one thing goes wrong, everything else doesn't collapse with it. Let's talk about earnings. Earnings are a company's profits. Companies report them every quarter, and these reports can cause massive price movements. When earnings are better than expected, stock prices often jump. When they're worse, prices can fall sharply. A related term is the PE ratio, price to earnings ratio. This tells you how much investors are paying for each dollar of profit a company makes. High PE might mean people expect future growth. Low PE might mean the company is undervalued or facing challenges. But here's the trick. PIE is most useful when comparing companies in the same industry, not different ones. Another important term is EPS, or earnings per share. This simply tells you how much profit the company makes per share. If EPS grows over time, that usually means the company is doing well. Dividends are another major concept. A dividend is money paid by a company to its shareholders from its profits. Some companies pay dividends regularly. Others don't pay them at all because they reinvest profits back into the business. Some people invest only for dividends because they want steady income. Others want growth and don't care about dividends. If you had to pick steady dividend income or long-term growth, which strategy would you choose? Tell me in the comments. I'd love to see your thinking. Now let's go deeper into important terms beginners always hear. Supply and demand. Stock prices change because of supply and demand. If more people want to buy a stock, high demand, the price goes up. If more people want to sell, high supply, the price goes down. Every price movement in the market comes back to this simple idea. Analysts are professionals who study companies and make predictions. They give ratings like buy, hold, or sell. But remember, analysts aren't fortune tellers. Their opinions can help, but investors should always do their own research. Let's talk about IPOs, initial public offerings. This is when a company sells shares to the public for the first time. People often get excited about IPOs because they think early investing means big profits, but not every IPO performs well. Some rise quickly, others fall. IPOs are exciting, but risky. Then there's the term blue chip stocks. These are large, well-known, financially stable companies that have been around for a long time. They are considered reliable and safer for beginners. Companies like Apple, Microsoft, or Coca-Cola fall into this category. Growth stocks are companies expected to grow faster than average. They usually don't pay dividends because they reinvest profits into the business. Value stocks are companies that appear undervalued compared to their actual worth, sort of like finding something great on sale. Income stocks pay high dividends. This brings us to ETFs, exchange-traded funds. An ETF is like a basket of many stocks grouped together. By buying just one ETF, you instantly own small pieces of many companies. ETFs are great for beginners because they're simple, diversified, and often low cost. Mutual funds are similar to ETFs but are managed differently and often have higher fees. ETFs trade all day like stocks. Mutual funds trade only once a day. Another big term is the index. An index is a group of stocks that represent part of the market. The S&P 500, for example, tracks 500 major U.S. companies. When people say the market is up today, they're often referring to an index. Let's talk about margin. Margin means borrowing money from your broker to invest. It can amplify your gains, but also your losses. Margin is powerful but dangerous for beginners. If you use it without understanding the risks, you can lose more money than you invested. Short selling is another advanced concept. This is when you bet that a stock's price will go down. If it does, you make money. If it goes up, you lose money. Short selling can be extremely risky because your potential loss is unlimited. At this point in the video, if you're learning something new, take a second to like this video, subscribe to the channel, and share it if you think more people should learn this information in simple language. It really helps the channel grow so I can make more content like this. Now let's continue with more terms that can confuse beginners. Volume is the number of shares traded in a day. High volume means heavy trading. Low volume means lighter activity. Volume often increases when big news comes out. Beta is a term that measures how volatile a stock is compared to the market. A beta above 1 means the stock is more volatile. Below 1 means it's less volatile. Beginners don't need to focus on beta too much, but it helps you understand risk. Another term is market sentiment. This is the overall feeling or mood of investors. Fear, excitement, optimism, pessimism. Even though this isn't a hard number, sentiment affects the market every day. Support and resistance are terms used in chart analysis. Support is a price level where a stock tends to stop falling. Resistance is a level where it tends to stop rising. Traders use these points to predict price movements, although they aren't guaranteed. Capital gains are profits you make when you sell a stock for more than you paid. Losses are when you sell for less. Taxes apply differently depending on how long you hold a stock, short-term versus long-term. Rebalancing is when you adjust your portfolio to maintain your preferred level of risk. If one stock grows too big in your portfolio, rebalancing helps restore balance.
Now here's something interesting. Many beginners don't realize that investing isn't just about knowledge. It's about discipline. Emotion, fear, greed, these are things every investor must manage. So here's a question for you. What's the biggest emotion you struggle with when it comes to money? Fear of losing it or fear of missing out? Tell me in the comments. Your answer can help someone else. We've covered nearly every important term beginners need. Stocks, shares, brokers, exchanges, tickers, market cap, bulls, bears, volatility, liquidity, orders, portfolios, diversification, earnings, PE, EPS, dividends, analysts, supply and demand, IPOs, blue chips, growth stocks, value stocks, income stocks, ETFs, mutual funds, indices, margin, short selling, volume, beta, sentiment, support, resistance, capital gains, and rebalancing. Now that you know the vocabulary, the world of investing becomes much easier to navigate. The stock market isn't a mystery, it's a system. And once you understand the language, you understand the system. If you enjoyed this guide and want more videos that make financial topics easy and fun, don't forget to like, subscribe, and share this video. And before you go, answer this final question in the comments. Which stock market term finally makes sense to you now that didn't before? I'm excited to read your responses.